Okay, let's get into it. It's kind of amazing when you think about it. People aren't just, traveling again. They're actually prioritizing spending on leisure, on vacations, more than almost anything else, like more than eating out, concerts, shopping, even self-care. It's a really energetic backdrop for what we're diving into today.
Exactly. And today we are diving deep into the latest earnings call from Royal Caribbean Group, their Q2 2025 results.
Yeah, our mission here is to really cut through all the numbers, the jargon, We want to pull out the key insights, the surprising bits, the big strategic moves that show you where this vacation giant is actually heading.
We'll look at why that second quarter was so strong, what they're seeing from
Right.
consumers, which is fascinating.
Yeah.
And they're pretty ambitious plans for what comes next. We'll get up to speed fast.
And we've gone through the official earnings call transcript, the press release, all of it to bring you the important stuff. So let's start with how things are looking right now, their Q2 performance.
Right, so first things first. Royal Caribbean's Q2 results weren't just okay. They really beat expectations pretty significantly across the board.
They really did. Their adjusted earnings per share EPS that hit $4.38. Now, that's a 36% jump from last year. And it beat their own forecast by what, $0.33? That's quite a beat.
It is. And revenues were strong too, $4.5 billion total. Adjusted EBITDA came in at $1.9 billion. And check this out. Their margin was 41%. That's 300 basis points, 3 full percentage points better than last year. Shows real efficiency gains.
Okay, so huge numbers. But why? What drove that outperformance?
Well, a big piece of it, maybe surprisingly, was stronger close-in demand. Basically, more people booking cruises much nearer to the actual sailing date than they expected.
Huh. So spontaneity is up. It's not just overall demand, but how people book is changing.
Seems like it. And there were other things, too, on the cost side. Their operating expenses were lower than expected, partly due to timing. Plus, better results from their joint venture, TUI cruises, and lower interest costs helped as well. It's kind of a mix of factors.
Okay, makes sense. And what about the ships themselves? Occupancy?
Oh, stellar. Load factor hit 110%.
110%? How does that work?
Yeah, it sounds weird, right?
Right.
It means they're effectively filling more spots than standard double occupancy because you have families or groups putting 3, sometimes 4 people in a cabin. It's 2 percentage points higher than last year, which, just shows really strong demand, and they're using those ships efficiently.
Right, squeezing every bit of value out. And yields, how much are they making per passenger?
Also good news there. Net yields grew 5.2% on a constant currency basis. That was 70 basis point, 0.7 percentage points better than they guided for. It's a really healthy sign. Shows the new ships are doing great, but also the existing fleet is pulling its weight, earning more.
So people are booking more spontaneously, ships are full, they're making more per guest. It begs the question, what is really driving this? Why are people flocking to cruises right now? They must have some insights into consumer behavior.
Oh, absolutely. Their data suggests that 3 out of 4 consumers feel financially secure right now. Strong job market, wages are up, people still have some savings built up, wealth levels are high. That confidence is key.
Okay, so people feel they can spend, but why cruising?
Well, interestingly, consumers are saying leisure and travel is their #1 priority for increased spending over the next year. That's ahead of dining out, live shows, shopping, even self-care, like you mentioned earlier. Travel is really the focus.
Wow, travel is king.
It really seems that way. And there's a demographic shift happening, too. Millennials and younger generations, they now make up fully half of Royal Caribbean's customer base.
Half. That's huge.
Yeah.
I guess the old stereotypes about cruising are fading fast.
Definitely. And these younger folks don't just want to travel more, they're specifically choosing cruises for big life moments, celebrations, things like that. It's becoming a go-to option.
And they're probably driving that spontaneity, right? Booking closer to the date.
Exactly. About 7 out of 10 younger consumers are booking closer in. They want that flexibility. Plus, the value aspect is a big draw. That all-inclusive feel, it's appealing. And it seems to be winning over people who might have been skeptical about cruising before.
Yeah, you hear that more and more. And digital must play a role here, too.
A massive role. Their digital channels are performing exceptionally well. That's for booking the cruise itself and for buying things before you even get on board. Think about this. Nearly half of all onboard purchases are now made through their app before the cruise starts. That's up from just a third in 2023.
That's a huge jump. And they found something interesting about those pre-cruise purchases, didn't they?
Yes, this is a key insight for you listening. Customers who buy onboard experiences like drinks packages, excursions, specialty dining before they sail. they end up spending about 2.5 times more overall compared to those who wait to buy on board.
2.5 times. So engaging people early through the app really drives spending. That's powerful.
Hugely powerful, which transitions us nicely into their longer-term strategy. Given this strong performance, how are they building on it? This brings us to their Perfecta vision.
Right, perfecta. They're aiming for some pretty ambitious financial targets by 2027.
They are. And they say they're well on track. The goals are a 20% compound annual growth rate in adjusted EPS. That's huge. And a return on invested capital, ROIC, in the high teens by 2027.
And how are they planning to hit those numbers? What's the formula?
Well, according to their CEO, Jason Liberty, it's about a balanced approach. Moderate growth in capacity, so adding ships steadily, not crazily. Moderate growth in yield, continuing to get a bit more revenue per guest. And just really strong cost discipline, keeping expenses in check.
Seems like a solid plan, but they're looking even further ahead, aren't they?
Oh, yeah. They're quite clear that their ambitions go well beyond Perfecta. They're talking about a significant step change in earnings power coming in 2028 alone. The message is, Perfecta is just the next step. After that, they plan to, well, reshape the vacation market even more.
Reshape how? What are the big levers? New ships must be part of it.
Definitely. They have a really strong pipeline. Star of the Seas, the next Icon-class ship, was just delivered, set for a star-studded launch very soon, and bookings are apparently really strong. Then Celebrity XL arrives in Q4 this year, also seeing high demand.
And beyond this year.
The pipeline keeps going. Legend of the Seas in 2026. Then in 2027, you get Icon number 4 and the first river cruise vessel for Celebrity. And then 2028 brings Oasis number 7 and Edge number 6. So what's that? 7 new ships over the next few years, a major investment.
Wow, that's aggressive. But it's not just ships, right? They're making huge bets on land, too, these exclusive destinations.
Yes. This feels like a really crucial part of the strategy, maybe even a game changer. Look at the Royal Beach Club Paradise Island in the Bahamas. It opens late 2025. First sailing visiting is December 21st, and they say early demand is incredibly strong.
Strong is one thing, but I heard a crazy story about the pricing.
You probably heard about the cabana. Apparently, one of the Ultimate Family cabanas sold for $10,000 for one day, and it sold within the first hour they were available.
$10,000 for a day pass. Okay, that's aspirational pricing. What's the standard entry?
Starts around $139, but they're using dynamic pricing, so it'll fluctuate. They plan to ramp up slowly, make sure the experience is perfect from day one.
Makes sense. So how many people do they expect to actually use it?
They're projecting about a 33% attach rate. So out of the 3 million guests they expect to visit Nassau annually, they think about 1 million will pay to go to the beach club. That's a significant new revenue stream.
1 million people paying $130 plus. Yeah, that adds up. But does focusing on $10,000 cabanas risk putting off the people drawn by the value message? How do they balance that?
It's a good question. I think the strategy is about offering a spectrum. You have the core cruise, which still offers that broad appeal, that value. Then you layer on these premium exclusive options like the beach club for those who want it and are willing to pay more. It's about adding choice, not necessarily shifting the whole focus to luxury.
Okay, I see. And the Bahamas Club isn't the only one. There's a big one coming in Mexico, too.
Oh, yeah. Perfect day in Mexico,
Yeah.
slated for late 2027. And get this, they describe the footprint as being approximately the size of the Magic Kingdom in Orlando.
Wait, the size of Magic Kingdom for a cruise line private destination.
That's what they said. It's designed to offer a ton of different experiences. They mentioned the world's largest lazy river, a Vegas beach party kind of area, even the world's largest sombrero, apparently.
Okay, they're going big.
Wow.
And location matters too, right? Mexico opens up new markets.
Absolutely. It's strategic for attracting guests from Texas, the West Coast, places where maybe a Caribbean cruise wasn't as easy before. The scale here suggests they're really blurring the lines, between a cruise port stop and a full-blown destination resort experience.
It really does. Are there others planned too?
Yep. They're extending this portfolio. There's a Royal Beach Club planned for Cozumel in 2026, another called Royal Beach Club La Lapa in the South Pacific for 2027, and they also just closed on acquiring the port of Costa Maya in Mexico. So they're really serious about controlling more of that land-based experience.
It's a massive expansion on land. With all this development, especially in diverse places, what about the local impact and the logistical challenges?
They do emphasize the community commitment. They talk about creating thousands of local jobs, investing in environmental projects like restoration and wastewater treatment, supporting education. It's a necessary part of getting these large projects approved and operating smoothly. As for challenges, yeah, it's huge. Acquiring land, construction, staffing, operating these massive sites globally, all while keeping guests happy. It's incredibly complex. It requires um, massive capital and meticulous planning, but they seem confident they have it mapped out.
Okay, so we have new ships, massive new destinations. What else is driving that long-term vision? Digital must be key.
Absolutely central. They call it their commercial flywheel.
Yeah.
They're investing heavily in a modern digital travel platform using AI pretty much everywhere. The goal is make things smoother for guests, create more selling opportunities, and actually lower the cost of acquiring customers. It feeds itself.
And loyalty programs fit into that.
Big time. Repeat bookings are up. People who cruise on one Royal brand are increasingly trying their other brands like Celebrity or Silver Sea. Nearly 40% of all their bookings now come from loyalty members. And get this, those members spend, on average, 25% more per trip.
25% more. That's a huge incentive to keep those members happy and engaged.
Exactly. Which is why they also mentioned they're working on a very meaningful upgrade to their co-branded credit card program. It's all tied together: loyalty, spending, digital engagement.
Okay, so the strategy is multifaceted, ships, destinations, digital. How's the underlying financial health to support all this?
Looking pretty strong. As of the end of Q2, June 30th, they had $7.1 billion in liquidity. That's a solid cushion.
And they got those investment-grade credit ratings, right, from all the major agencies.
Yes. In the first half of this year, all three main agencies upgraded them to investment grade. That's a huge vote of confidence from the financial world. It signals strength, discipline. They also just expanded their revolving credit facilities, basically their accessible credit lines, to $6.4 billion and pushed out the maturity date on one part to October 2030. Lenders are clearly comfortable.
So they have the resources. How are they prioritizing spending that money, capital allocation?
The focus is clear. First, invest back into the business for growth. It's the ships, the destinations. Second, maintain a competitive dividend for shareholders. And third, opportunistically buy back their own shares. And that share buyback piece is interesting because it provides another boost to EPS. And that boost isn't even factored into those perfected targets we talked about. It's potential upside.
Good point. Okay, looking just ahead then, what's the outlook for Q3?
For the third quarter, they expect capacity to be up about 3%. Net yield growth is forecast between 2.0% and 2.5%. Now, that yield growth is mainly coming from the existing fleet performing well. Because Star to Seas launches so late in the quarter, it actually creates a bit of a drag, about 1.5 percentage points on that yield growth number.
Why a drag? Shouldn't a new ship help?
Well, it launches very late, so minimal contribution. Plus, during the initial ramp-up phase of a new ship, they intentionally limit the load factor. They don't pack it 110% right away. They want to make sure everything runs perfectly, the crew gets settled, the guest experience is exceptional from day one. So that initial period slightly lowers the overall yield metric for the quarter.
Ah, okay, that makes sense. Short-term caution for long-term quality. And the bottom line for Q3 KISS.
They're expecting adjusted EPS to land somewhere between $5.55 and $5.65 for the third quarter.
So despite maybe some economic noise out there, they sound pretty confident overall.
Extremely confident. They feel they have a strong grip on costs, on their investments. They're really focused on the bigger picture. They keep talking about the gap between the cruise market, maybe $80–85 billion globally, and the total global leisure market, which is closer to $2 trillion.
Yeah, that's a huge difference.
Right. And their point is, every single percentage point of that massive leisure market that they can capture for cruising is worth, as they put it, a tremendous amount of money. Their vision isn't just about being the best cruise line. It's about capturing a bigger slice of the entire vacation pie.
So wrapping this up, what's the big takeaway for you listening?
I think it's that Royal Caribbean Group isn't just, benefiting from travel coming back. They are actively, aggressively shaping what leisure travel looks like for the future. They're making these huge strategic bets on innovative ships, these game-changing land destinations, and the tech to tie it all together. They're playing the long game.
Yeah, they're thinking big and executing big. So here's something to chew on as we finish. Think about these huge land destinations, like Perfect Day in Mexico being the size of Magic Kingdom. How could that fundamentally change what you even think a cruise vacation is over the next few years? What new kinds of trips does that open up? Could you really end up taking a lifetime of vacations, experiencing vastly different things, all within the ecosystem of just one travel brand? Interesting times ahead.